live, and some of you it's the morning, some of you it's the afternoon, some of you the evening, but we are about to live stream the Canopy Growth Corp CGC weed earnings call. Thank you guys for joining Rich TV Live. I don't know what this earnings call is going to look like, but we will see. Now, some of you guys know what the results look like for Canopy Growth in advance. I haven't even looked. So this will be new to me. Please let me know. Let's see. So if anybody knows what the results look like for CGC, please let me know in advance. I'm totally not knowing what to expect right now, but we are about to live stream the earnings call and we are representing the media. We have signed in and this call should be live in 8 minutes. Buys Major says, think Xena will make a jump soon with some announcements coming out. Xena's been a nightmare. I don't really think about Xena anymore other than just the fact that I've lost so much money. So I don't really have a lot of confidence in Xena. And what I'm finding is I'm losing confidence in the sector because I'm going to be quite honest with you. The black market has embarrassed the public companies. Troy says, Rich, home today. It's too cold. At a work job, got shut down. Oh, wow. Well, enjoy your day off, man. Enjoy a nice weekend. So there it is. Jerry C says EBITDA loss of 92 million. Yeah, that's not very good. That's clearly not very good. So this cannabis sector has not been what I thought it would be. I thought that these companies would generate profits. They're not. I thought these companies would grow. They're not. I thought the revenues would grow. They're not. All their revenues are shrinking. So it's very, very disappointing. I know that Supreme Pharmaceuticals revenues went down. Aurora Cannabis's revenues went down. Here in Canada, the black market is reigning supreme, and they're laughing at the public companies. And what I'm saddened about is that they're laughing at our expense because the public companies management has made millions and millions and millions of dollars just selling stock. Meanwhile, we're the idiots that are buying their garbage. And I'm telling you guys right now, those days for me are over because I've come to realize that this sector is not what I thought it would be. I'm not here to blame Health Canada. I actually am blaming these LPs because, to be quite honest with you, have you guys gone to a dispensary? Have you seen the pricing? The pricing's not competitive. Yeah, there's a couple products here and there. Zenabis has a pretty reasonable product pricing. Hexo has a pretty reasonable product pricing. But the majority of these LPs, their products are too expensive, and that's why they're not getting sales. It's pretty obvious. It's pretty simple. And these companies don't want to reduce their pricing. And if they're not going to reduce their pricing, they're going to get obliterated by the black market. And that's exactly what's happening. So I'm not going to sit there and continue to dump my money into a sector that's a failing sector. The reality is this is a failing sector. You know, we thought, okay, they're going to get the profitability. Well, they can't. Let's be honest. They can't get the profitability. It's not that they don't want to. They can't. That's why their prices are so high. Their prices are so high because they're trying to make money. But the thing they're not realizing is when you go to a dispensary, everybody looks for the cheapest price. I do. I go to the dispensaries, I look for the cheapest price, and buy the cheapest product. So if your product is the highest priced product, you're not going to get any sales. I'm sorry. Some of these companies, they haven't got the memo or something. I was like, do you guys not know the way cannabis works? People want the best product at the lowest price with the best customer service. It's pretty simple. And if your pricing is too expensive, which 95% of these products are too expensive, guess what? Everybody calls up their buddy across the street and says, you know what? I went to the dispensary, but the prices were ridiculous. You know, how much you getting for an OZ? $100? Yeah, I'm coming over. Or can you come buy my house? Why would anybody buy products from an LP that cost them more that they can get from their neighbor? Because remember, legally now in Canada, we can just grow our own. So guess what? That's what people are doing, guys. That's exactly what people are doing. They're growing their own now. So yeah, this sector is not what I thought it would be. Nowhere close. It's not just Aurora Cannabis. It's not just Canopy Growth. All these companies are fucked. They're all fucked. Here we go. So we are now waiting for these jokers here from Canopy Growth with their $92 million EBITDA loss. So we'll be live in 3 minutes. And this is what I'm saying. Like, a lot of people think these companies are just going to make tons of money, but they're losing tons of money. And the reality is their pricing sucks. And when your pricing sucks and you're losing money, how are you going to become profitable? So the only way that these managers in these companies can make money, can get paid, because they're under so much pressure, and they're constantly thinking about how they're going to make money, and they can't. Well, guess what? The only way they can make money is by selling stock. And the reality is the only way that they're going to make money by selling stock is by taking advantage of us, the shareholders, by buying their stock. So this just isn't what I thought it would be. The private sector is killing the public sector, specifically in Canada. The reason why the LPs in America are doing better than the LPs in Canada is because the LPs in America understand pricing. They understand pricing. This is what I'm trying to say. Like, people think they know about this sector. I know about the sector because I go to the dispensaries. I see the list of pricing. I see the Aurora pricing. I see all the pricing. Aurora does not have the cheapest product. CANNABIS has one of the cheapest products in the re-up product. Sundial has a pretty cheap product. THC Biomed has a cheap product. These are the companies that have cheap products that are the ones that are selling out. And then the high-end products, only the high-end people are buying the high-end products. So the average investor isn't buying those products. They're just not. These companies just don't get it. Like, how stupid can they be? This is what I'm trying to say. Like, do these companies actually want to grow a real business, or do they want to continuously have managers and CEOs that really know nothing about the sector? This is why I said I should be the CEO of Aurora Cannabis, because I know exactly what Aurora needs to do to turn a profit. But clearly they don't, because they're not selling enough product. Why are they not selling enough product? Pricing. It's just so basic. It's stupid that I'll go into a dispensary and I look at the Canopy product. I look at the Aurora product. It's too expensive. Nobody's buying it. CANNABIS product is cheaper. Sundial's product's cheaper. THC Biomed's product's cheaper. There's a reason, guys. These LPs are not going to be profitable until they lower their pricing. And the reality is they might not be profitable if they lower the pricing. And if they're not profitable if they lower the pricing, and if they're not profitable if they keep their pricing up, then guess what? They're done. And that's why the black market in Canada made $5 billion in 2019, and the public sector made like $1 billion. The public sector is getting crushed by the private sector because of pricing. You're legal versus illegal, and you can't beat the illegal? Why? Because of pricing. People want to buy from the legal guys. But if you're charging $240 an ounce, and I can get my ounce for $100 from my buddy, or I can grow it myself, what do you think people are going to do? Let's just be honest. These are the real reasons why these companies are struggling. People are going to go into the dispensary. They're They're going to see the prices. They're going to walk right out, and then they're going to go to the corner store. Or they're going to go to their buddy that's selling it illegally for half the price. Seems like common sense to me. But all these genius CEOs with all these degrees who know nothing about cannabis are running these companies into the ground because they don't have a freaking clue. Troy Welsh says 1.5 billion public versus 5 billion black market. Well, there you go. Pricing, pricing, pricing. The issue is pricing. And these guys just don't get it. These public companies just don't get it. And this is why I'm saying you need someone that actually knows the game running your business if you want to compete with the black market. How are you going to compete with the black market if you don't understand the market? This is the problem. You got a whole bunch of bankers running public companies who know nothing about cannabis, know nothing about the market, know nothing about selling cannabis, have never sold cannabis in their lives. This is why they're failing. Clearly, this is why they're losing so much money. And they make all these excuses. Oh, we're building this and we're building that and we're spending on this and we're spending on that. So you're just wasting money. How about your sales? How about your revenue growth? How about EBITDA? How about profitability? Why are all the black market guys profitable? They're not losing money, but the public guys are losing money. So what are we going to do? We're going to sit here and keep buying their garbage? Nah, man, that guy's profitable. They're not losing money, but the public guys are losing money. So what are we going to do? We're going to sit here and keep buying their garbage? Nah, man, not this guy. You guys can do whatever you want, but I'm done. I'm done. These guys are trash. All these companies are complete trash. Complete and utter trash. They have no clue what they're doing. And they're spinning their wheels. They do these calls and they just dodge bullets, dodge calls, dodge questions, have no answers for the public, no real solution to a path to profitability. And as investors, we sit here in this abusive relationship and continue to buy this garbage, these garbage companies who do not know how to make money. It's sad. They've just destroyed us all. They've destroyed all of us investors. We've all just been destroyed. Troy, the problem is these companies, if their pricing isn't comparable to the black market, nobody's going to buy it. Nobody's going to buy anything if the pricing isn't affordable. And this is really the problem that I see and why I think companies had better revenues before and now the revenues are falling. We're spending way more than they can get it from their buddy next door. They started going back to their buddy next door. That's why we see the pricing stay high and we see the revenues stay low. And until these companies get it and they start competing with the black market, the revenues are not going to grow. And this is my biggest fear. Now, companies like Canopy Growth are different because they got billions behind them. Companies like Kronos Group are different because they got billions behind them. But if your company doesn't have billions behind you, how long will you be able to continue to lose money? That's the $1 million question. And the reality is there's only a handful of companies that are making money, and a lot of them aren't even cannabis companies. They're extraction companies. It's a totally different business. They're not selling cannabis. So that's why they're able to become profitable. They're not competing in this saturated marketplace where everybody's fighting for the same customer dollar. And nobody's willing to reduce their prices to the black market level. And if you're not willing to reduce your prices to the black market level, then you're not going to be able to compete with the black market. It's pretty obvious. Okay, we will be live with this earnings call any minute. We're already past 7. What's going on? Come on, Canopy Growth. What's going on? You guys running late here? Why would you be running late for your own call? Okay. Five Finger Limited says made a killing on CGC. Troy, you know what? I understand what you're saying, but the reality is people don't care, man. People want. Here we go.
At this time, all participants are in a listening mode. I will now turn the call over to Judy Hong, Vice President, Investor Relations. Judy, you may begin the conference call. And good morning, everyone. We're glad that you have taken the time to join our third quarter fiscal 2020 financial results conference call. On our call today, we have David Klein, our CEO, and Mike Lee, our CFO. Before the markets opened today, we issued a news release announcing our financial results for our third quarter fiscal 2020 ended December 31st, 2019. This news release is available on Canopy Growth's website and has been filed on SEDAR. Certain matters discussed in today's call or answers that may be given to questions could constitute forward-looking statements, actually materially from those anticipated. Risk factors that could affect results are detailed in the company's annual information form and other public filings that are available on SEDAR. During the call, we will refer to supplemental non-GAAP measures, adjusted EBITDA and free cash flow. Adjusted EBITDA and free cash flow are defined in the press release issued this morning, as well as this period's management discussion and analysis document filed in SEDAR. Please note that all financial information is provided in Canadian dollars unless otherwise noted. Following prepared comments by David and Mike, we will conduct a Q&A session. To ensure that we get to as many questions as possible, we ask that analysts to limit themselves to one question. With that, I'll now turn the call over to David. David?
Thank you, Judy, and good morning, everyone. I'm very excited to be on this, my first earnings call as CEO of Canopy Growth. To begin my remarks, I'll offer a perspective on why I decided to join Canopy. First, I believe the cannabis market is one of the most exciting business growth opportunities of our lifetime. We are taking part in the creation of a new regulated consumer market, the likes of which we have never seen. Second, having been an early advocate of Constellation Brands' investment in Canopy Growth, and having been on the board since October 2018, I firmly believe Canopy is well positioned to win in the global cannabis market. We have a leading market share in the recreational market in Canada and a strong position in the medical market in both Canada and abroad. Additionally, I believe Canopy has the opportunity to create an unassailable global position in cannabis. Canopy possesses excellent know-how, industry experience, intellectual property, and talent. The combination of these assets has the ability to set us apart from the competition. Another asset of Canopy's that cannot be overlooked is the strength of our balance sheet. In a sector where capital is becoming increasingly costly, if it's available at all, the value of having $2.3 billion in cash cannot be understated. Our job is to nurture these strengths and ensure that we build a profitable, world-class company with brands that consumers trust. Now, I know you'll have many questions about what I'm planning to do, especially in light of what's going on in our industry. Make no mistake, we have a lot of work to do. I'll detail our path forward during our fourth quarter earnings call once I've completed my assessment. However, you can be assured that I am, along with the management team, already taking actions that will keep us in the leadership position of the cannabis industry. For now, let me highlight my key priorities. My first priority will be improving Canopy Growth's connection with our consumers. The winner in this market will possess the brands that are most trusted and most loved by our consumers. We will leverage our consumer insights, intellectual property, and production capability to consistently deliver consumer-preferred products that deliver the best quality at each price point. My second priority is bringing more focus and discipline to our organization. As this new nascent industry developed over the past 5 years, playing across the board made sense due to uncertainty about industry direction. The industry, however, has evolved, and we now need to focus on specific markets and product lines where we have the legitimate right to win. This means deciding where we won't play as well as where we will. My third priority is to define a very visible path to profitability and positive cash flow. This means we need to align our resources and investments with the size and growth rate of the market as it exists today. We've begun taking steps designed to bring our inventory in balance with our supply-demand forecast. This includes a thorough strategic review of our footprint, which is underway. Mindful of future market growth, we're prepared to take initial steps to right-size our business over the next 90 days. My final priority is building the company and management's credibility with all stakeholders. We will do this by delivering on our commitments in a thoughtful and measured fashion. Let me now briefly cover some business highlights. First, the Canadian recreational market. Overall consumer demand remains strong, and Canopy continues to hold a leading market share in recreational cannabis markets across the country. At retail, and using data published by provincial agencies and StatScan, Canopy is number 1 in Nova Scotia, number 1 in Prince Edward Island, and number 2 in Ontario. In Alberta, the country's most developed market, Canopy continues to hold the number 1 spot, accounting for roughly 30% of the market. Our same-store retail sales increased 11% on a quarter-over-quarter basis. Sales of dried flower remain strong across all price ranges. Notably, strong demand continued for our value-priced TWD strain, as well as for premium strains. Moving to medical cannabis markets. We are seeing our sales increase in the Canadian medical market, thanks in part to a growing customer base. It's notable that sales of oil and softgels account for over 60% of our Canadian medical sales. We're encouraged by the progress we're making in key European markets with strong sales in Germany. In the U.S. market, we achieved an important milestone with online sales of First and Free branded hemp-derived CBD products beginning in December 2019. I'm excited about the U.S. market opportunity. Providing Canopy with the resources to enter the U.S. market was a key driver of Constellation's most recent investment. That said, we recognize that we want to and need to move faster and make bolder moves in the U.S. We're focused on creating brands that resonate with our consumers and making sure we can get distribution of our products in places where our consumers can legally purchase them. Now, before I hand the call over to Mike, I'd like to provide an update on our Cannabis 2.0 launch in Canada. Since the very beginning of our 2.0 product development, Canopy has been committed to bringing the highest quality, most differentiated products to market. We believe this is the best business approach to win over the long term. Our first edible products, premium chocolate products, shipped out of our Smiths Falls facility in December 2019. Multiple products, Tokyo Smoke Go, Tokyo Smoke Pause, and Tweed Baker Street entered the market in December and have been selling out very quickly. Our next offering, Bean and Bud, is on track to be in market late February, with additional SKUs following in the first quarter of fiscal 2021. For our vape product offering, we focused on delivering products with differentiated levels of safety, functionality, and design. All of our products will meet Underwriter Laboratories, or UL 8139 safety standards. Our Juju Power, the sector's only UL 8139 certified rechargeable battery for 510 cartridges, began shipping in December and entered the market in early January 2020. We're seeing strong demand for these devices. For our 510 cartridges and proprietary pod-based Tokyo Smoke Luma, we expect to be in market over the next few months. This is later than we previously communicated, but we felt our highest priority is to ensure that we provide our consumers with the highest quality and safest products possible, even if it means delays to our in-market dates. Lastly, Canopy has long believed in the low-calorie, high-quality cannabis beverages that rival alcohol beverages in the taste and social experience they deliver, would create a new consumer segment and expand the overall cannabis category. Leveraging considerable intellectual property, Canopy has formulated a range of beverages that I believe will delight our consumers. I know some of you had a chance to taste the non-active version of our products, but let me say this. The active versions are a whole new ballgame. To add some color here, a few weeks ago, myself and other board members tasted live versions of our cannabis beverages. After the tasting, a fellow board member sent me a text. The text read simply, "Game changer." I share that opinion. In our view, we truly have a unique and differentiated beverage, which, based on our competitive tasting, you can't find anywhere. We also see our cannabis beverage as truly disruptive and the best vehicle to attract new consumers to the cannabis market. In other words, we believe it will do more to recruit new consumers than any other product format in our industry, creating new consumption occasions and a whole new industry. Just think about how big hard seltzers in the U.S. became in just 3 years. So we are going to take the next few months to get it right and ensure that we can introduce our consumers of today and of the future to a true game changer. Lastly, and relatedly, I would like to take a brief moment to acknowledge and applaud the Ontario government's recent initiation of public consultation on providing consumers with more choice and convenience on cannabis and business opportunities, including consumption venues. The consultation is the first major milestone that's required to move forward with providing Ontarians with safe, convenient access to regulated cannabis while providing more support for private sector business opportunities. This concludes my remarks, and I'll now pass the call over to Mike to review our third quarter fiscal year 2020 financial results in greater detail.
Thanks, David. Good morning, everyone. Let me begin my remarks with a brief review of the progress that we made during our third quarter of fiscal 20. Total net revenue grew 13%, excluding the impact of portfolio restructuring charges last quarter. Our business generated gross margins of 34% before fair value impacts. Total SG&A decreased 14% quarter over quarter. And adjusted EBITDA came in at a loss of $92 million compared to a loss of $156 million last quarter. I will now move on to a more detailed review of select items. Our top-line performance benefited from a broad base of growth in our core cannabis business as well as our strategic acquisition. Here are a few highlights. Canada recreational revenue increased 10%, benefiting from balanced growth across our B2B and B2C channels. And we are pleased with the growth of flower sales, which were driven in part by higher sales of premium strains and a greater than 50% increase in the sales of pre-rolled joints. Our B2C revenue increased 16% over prior quarter, due in part to an 11% increase in same-store sales. Canadian medical sales increased by 5% quarter over quarter, driven in part by an increase in the number of customers to over 76,700. International medical increased 3% quarter over quarter as our sales in Germany benefited from opportunistic sales to fill supply gaps created by a regulatory hold on products of another vendor. Revenue generated by C3 increased by 5% over the prior quarter, driven by continued growth in demand for the cannabinoid-based therapies. And over the past year, Canopy has made a number of strategic acquisitions that are performing as expected. Sales of these businesses are captured at our other revenue section of our P&L, and they saw over 40% growth against the prior quarter. Sales of Storz & Bickel vaporizers increased 46% over the last quarter due to solid organic growth, as well as seasonal sales over the Christmas holiday season. And we estimate the seasonal timing benefit added around $5 million of incremental revenue during the quarter. This Works revenue revenue increased 42% on solid organic growth. Our latest acquisition, BioSteel, also contributed a full quarter of revenue. We are pleased with the performance of our strategic acquisitions and point out that Stores & Bickel, This Works, and BioSteel accounted for nearly 22% of our revenue in the quarter. Looking forward to the fourth quarter, taking into consideration some timing benefits we saw during the third quarter, we anticipate our overall revenue to be up modestly versus the third quarter. I would now like to take a few moments to provide Canopy's perspective on a dynamic that we are seeing in the Canadian rec channel. Over the past number of weeks, we've seen examples of aggressive pricing by some competitors, which began in earnest in the back half of the third quarter. And we expect these isolated pricing actions to continue, as our market intelligence suggests that these competitors are focused on freeing up cash from their long inventory positions. At the same time, we see strong consumer demand for premium, high THC strain products, as evidenced by the well over 50% growth we saw in our LBS Sunset premium flower and pre-rolled joints during the quarter. We believe our brand architecture is working as we focus on building brand equity while offering consumers a range of products across premium, mainstream, and value price points. And we will continue to monitor the market and adjust as needed to remain competitive, but TWD will continue to serve as our price fighter in the value segment. Now let me briefly cover gross margin. Gross margin in the third quarter of fiscal 20 before IFRS fair value impacts was $42 million or 34% of net revenue. Gross margin in the quarter benefited from higher capacity utilization, which is a trend that we've seen over the past few quarters. Operating costs related to underutilized facilities has continued to decrease from approximately $24 million in the fourth quarter of fiscal 19 to under $8 million in the third quarter of fiscal 20. The growth of our higher margin consumer product businesses such as S&B and This Works also had a positive impact to gross margin during the quarter. We remain committed to delivering 40% gross margins in the short term, as we expect ongoing reductions in various period costs, but we recognize that the delays in our beverage and products will serve as a modest headwind in the short term. It's also worthwhile highlighting that any right sizing on our supply could introduce some short-term headwinds as well. Speaking briefly about operating expenses, total OPEX declined 14% versus the prior quarter, and G&A declined by over $20 million versus last quarter, as a couple of discrete expenses were not repeated in the third quarter, as well as to focus on continued cost controls in this area. Share-based compensation expenses decreased from $92.9 million in the second quarter to $61.7 million in the third quarter. And the decline in stock-based compensation was due to certain one-time benefits, as well as reductions that resulted from the restructuring of our share-based compensation program that I spoke about last quarter. Looking forward to fiscal 21, and with the restructurings that we made, we expect share-based compensation to be 30 to 40% lower than in fiscal 20. Further, we expect share-based compensation to normalize over time at between $125 and $150 million per year, depending on headcount. Operating expenses from our press release and from this conference call, and you can expect this to be our standard practice in the future. Moving on to free cash flow. Our free cash flow in the third quarter of fiscal 20 was an outflow of $360 million. Priority is to reduce cash burn, and I am confident that the work that we started in January will identify opportunities to reduce operating expenses and will moderate our capital expenditures as we seek to focus our efforts and align our organization, having a supply and demand balance as quickly as possible. During the third quarter, our inventory before fair market value adjustments increased $81 million versus the last quarter. Acquisitions and our U.S. hemp harvest contributed around $20 million of this increase, but the balance was driven by an increase in our semi-finished goods such as resins, distillates, and isolate. David indicated in his prepared remarks, we have initiated a thorough review of our production footprint, and we plan to act quickly to right-size our supply to align with the current market demand while ensuring that we can deliver on our margin commitments. Next, I would like to provide a brief update on our transition to U.S. GAAP. Our preliminary review of the change in accounting principles has identified a number of changes to the consolidated statement of operations, and I will highlight a few of them now. First, under U.S. GAAP, there is no biological asset accounting. Under U.S. GAAP, agricultural products are accounted for at cost, and this change will have no impact on our adjusted EBITDA metric. Second, under U.S. GAAP, the amortization of right-of-use assets is no longer considered as a component of depreciation and amortization expense, and as such is not excluded from adjusted EBITDA going forward. And this will have an impact of reducing our adjusted EBITDA by an estimated $10 million on an annualized basis. The third item to be aware of is in our accounting for other financial assets and financial liabilities. There will be changes in the classification of certain other financial assets and liabilities, which will result in fair value adjustments impacting net income, and this is in lieu of reporting against OCI or other comprehensive income. And as these fair value adjustments are currently excluded from adjusted EBITDA, there will be no impact as a result of the change to U.S. GAAP. Finally, I would like to provide just a brief update on some of the priorities I covered during our last call. We are making tremendous progress in re-engineering our financial close and reporting processes, and we expect to achieve the accelerated close timelines required at our fiscal year end. We continue to make progress in improving our control environment, and we've begun testing the effectiveness of end-user computing controls, and we are on track to remediate the currently reported material weakness by the end of the fiscal year. We've also made solid progress in the design of our SAP ERP solution, which will eventually roll out across the entire enterprise, and we are on track to roll out the SAP solution in the United States beginning in the first quarter of fiscal 21. This now concludes my review of Canopy Growth's financials for the third quarter fiscal 20 ended December 31st, 2019, and we are happy to take questions from analysts at this time.
At this time, if you would like to ask a question, please press star, then the number 1 on your telephone keypad. To ensure an efficient call that gets to questions of as many analysts as possible, analysts are requested to limit themselves to one question. Once again, press star 1 on your telephone keypad to ask a question. Your first question comes from the line of Chris Carey of Bank of America.
Hi, good morning.
Morning.
First of all, David, congratulations on your new role. And I guess, like clearly a number of line items were quite a bit ahead of expectations on revenue and profit, right? But I think as you implied in the prepared remarks, the one area which still underwhelmed, was free cash flow, which is really where I think the debate around the Canopy story is focused now. And it sounds like we're going to get more details around that in fiscal Q4. So, perhaps I'll approach this question a little differently. You mentioned that managing inventory relative to demand was a key focus, and you're reviewing your footprint. Clearly, that could imply shutting down some production capacity. And I just wonder, from a practical standpoint, how difficult is that kind of endeavor? And what could that mean to near-term margins, even if positive for the long term? And I guess connected to that is, Mike, you had mentioned that you'll expect to get the 40% gross margin over time. potentially that's a mixed comment on the fiscal Q4, but did that imply that the 40% is more kind of a fiscal 21 reality? Anyway, so thanks for all those.
Yeah, sure. So, yeah, Chris, so first of all, we are not going to run out of cash. And we have a lot of levers to pull in that regard. And as I indicated, we'll talk about that more on the next call. Clearly, we have to do a better job managing inventory and overall working capital. We have to slow our CapEx spend. We will pull back on the M&A activity that the business has been doing, and we need to do a better job with our P&L. So literally, we need to work across their line item. We're going through a review process. I've been in the role actually. It's 1 month today, and I will say that the team is a very strong team at the leadership level at Canopy, and the team is very committed to the objectives that I talked about, my priorities that I talked about in my script. So I'll let Mike comment on the timing of margin achievement, but we will do the right thing for our stakeholders, which means our shareholders, our consumers, and our employees. And we'll communicate that as soon as we can. And then when we do, there'll be an obvious flow through that will have to be taken into account.
I would just add to that whatever we do, we want to do it with an eye toward not just what works for today, but what works for the long term as well. And as you guys have heard me talk about over the last year, starting up and shutting down facilities is really hard. So we need to be very thoughtful about it, very mindful about it. And we're taking a strategic approach to say, look, we want to make sure that we're designing our supply chain and our footprint for not just the realities of today, but the realities of the next year, 2 years, 3 years, as the size of the market develops, but also as the various categories of the market develops. And we know that the value category is here to stay. We're quite happy with how TWD is performing in the market, and we want to make products that we offer to our consumers. So that's the work that's underway, and really to engineer the ideal supply chain that allows us to achieve those financial objectives. So in the short run, are we going to face some headwinds with some of the cannabis delays? Yes. Are we going to face some headwinds from some potential deleveraging of facilities in the short run as we make some fine-tune adjustments? Yes. Is that going to move us materially off of our 40% gross margin goal? I do not think it will.
Your next question comes from the line of Glenn Mattson of Ladenburg Thalmann.
Hi, yeah, thanks for taking the question. David, you made very specific comments about the U.S. market opportunity. I believe you said that you see a need to move faster in the U.S. creating brands, specifically and getting distribution to customers who can buy them. So I'm curious what you meant by that a little bit. Number one is, do you see yourselves having to make a significant further investment in the U.S.? And then number two, when you mention customers who can buy them, are you talking about THC-based products to customers in the U.S.? Maybe just flesh out those comments a little further. Thanks.
Yeah, so where we sit today, it's really focused on hemp-derived CBD, and there are states where we're free to to sell our products, in other states where we're not. So that was really the point of that comment. And I don't see significant investments. Clearly, no incremental capital required in the U.S. It's really more about getting our brands on the shelf at retail as much as we possibly can across the U.S. We launched First and Free in December. It was mostly an e-commerce launch. We now need to get on the shelf with First and Free and with some of our other products such as BioSteel with CBD in the U.S. So it really is more about execution. And, quite frankly, Glenn, I think that's a point that I can make about Canopy in general. I think we're well positioned in terms of product development and production capacity. We now need to begin to really connect with that consumer and execute from a sales standpoint and a brand building standpoint so that we can create that those trusted brands in the minds of the consumer. That's the next stage of our evolution, and clearly we'll be focused on that in the U.S.
Your next question comes from the line of Vivian Azur of Cowen and Company.
Hi, good morning, and congrats, David, on the new role. Thank you very much for the prepared remarks. I was hoping to get some perspective strategically, David, from you on kind of the balance of priorities between top line growth and profitability. It seems from your commentary that clearly there's a laser focus on right sizing the business from both you and Mike, which I think is encouraging. But you did make a point of reinforcing your market share leadership in the category, and so I'm just trying to understand how committed are you to market share leadership? Are you willing to sacrifice that to attain your profit aspirations? Because given your background, you certainly, I think, would be comfortable not being a market leader, but operating from a position of market share gains once you've achieved the right profitability framework. So any commentary on that would be helpful. Thanks.
Yeah. So look, that's why we haven't raced to put out, cut numbers, for stat, what you're seeing across the industry, because I think it's important to understand where we need to win and where we want to win and where we can profitably play in the business. And then we'll continue to invest in those areas, and we'll pull back spend from the areas that don't fit into that category. I think the thing that we do have to keep in mind, though, is that we are in a growth industry, and I know there's a bit of a pall over the industry of late, but we need to keep in mind that this is a growth industry. We're still attracting new consumers to the space. We see ways for us to be profitable across the spectrum as consumer preference, as Mike talked about our ability to be profitable at the value end as well as our ability to be profitable at the premium end, and we just need to get our business focused on executing in those areas. I think there is a school of thought, though, that we can continue to drive industry share leadership and improve profitability at the same time by simply creating a tighter focus on the consumer proposition.
Your next question comes from the line of Adam Buckham of Scotiabank.
Good morning. Thanks for taking my question. So I was just hoping we could get a little more color on the B2B segment. So just want to get an idea whether there was any bulk sales in the quarter, and if there was, what the magnitude of those were versus previous quarters. Thanks.
Yeah, thanks, Adam. We did have some bulk sales in the prior quarter. This quarter it was non-existent, to my knowledge. Continues to be an area of consideration as we think about right-sizing our inventories across certain segments of the value tier, but at this point, we're focused on getting our product to market, not necessarily pursuing wholesale, but that's an option that continues to exist.
Okay, great. Thanks.
Yep.
Your next question comes from Andrew Carter of Stifel.
Hi, good morning. I just want to return to kind of the comment around the modest revenue growth quarter over quarter, and just kind of help us understand what that means for the rec business. You called out the $5 million of seasonality, suggesting a 119 base, but how should we be thinking about Canadian recreational business? I would assume that the business is now kind of aligned where shipments will better match kind of the consumption growth of the market. Should we be factoring in a lot of price compression? You obviously will have some second wave shipments. Just help us understand how you're thinking about that line item.
Sure, Andrew. We're not modeling in anything for price compression at this point. We are modeling in that the mix in the category continues to evolve as TWD establishes itself in the marketplace, and that brand is performing quite well. But the high end is also performing quite well. The pre-rolls are performing quite well. My comments around the modest growth in the quarter are really driven by just, as I mentioned, some of the seasonality benefits from S&B, and even our retail stores in Canada benefited from a very strong December. So there's a bit of a headwind going into the next quarter as a result of that. And store count continues to increase, and you're correct. We are seeing tremendous benefits of supply chain stability. All the provinces are now getting their inventories in order, and we're starting to establish a cadence of not quite a mature industry, but there's line of sight to get into a mature industry in the near term. And quite honestly, our biggest opportunity today to grow in what's relatively a static sort of store count environment is continuing to get the right product at the right time as the purchase orders come in from the provinces, driving our fill rates up by better forecasting and better fulfillment. So that's where our growth is going to come from in the near term, and then as the stores continue to increase, we'll continue to deliver.
Your next question comes from the line of John Zamparo of CIBC.
I wanted to ask about the retail function at Canopy. So subsequent to the quarter, you announced a meaningful increase in the total footprint in terms of the Ontario licensed lottery winners. I assume it's fair to say that you've seen something about retail that's made you want to get more involved. So I'm wondering, is it as simple as unit level economics are really attractive, or is it more the ability to sell your own brands? But just would like to get a sense of how you view retail and maybe how much capital you might allocate to that over the next couple of years.
Yeah, great. Store count continues to increase. I think we added 15 stores in the quarter, 12 stores in the quarter, from 15 to 27 between owned stores and partner stores. But we're very happy with our store performance. And the economics become very attractive in our stores when Canopy's share of store sales reach that 60% plus range, which we're starting to see across our network. But that gives us the best opportunity to build brands, to educate consumers. It allows us to do pop-up activities to help educate consumers on different formats and things like that. And then as Cannabis 2.0 rolls out, it's going to be an incredibly valuable format for introducing new consumers to these new products as well. So we expect to continue to add stores in a very strategic way. Ontario is our biggest opportunity in front of us, and we had a press release about that a few weeks ago that I'm sure you saw. So it continues to be a priority for us.
Your next question comes from the line of Michael Lavery of Piper Sandler.
Thank you. Good morning. You touched on a couple of the drivers of the inventory build, and obviously some of the 2.0 launch and building into that is a part of it as well. Can you just give us a sense of how it's likely to evolve from here? And was this last quarter the peak inventory levels, or is there any reason it might actually still go higher? How do you see that working down, and at what kind of speed?
I'll let maybe Mike comment on some of the details, but my early observations, Michael, are that we're as a company, we've built inventory, but we need to get better at connecting the consumer demand signal to the inventory that we're building, so that we can deliver that high-end consumer experience that is expected of leaders in a space. And I think we're in the early innings of brand building in cannabis, and so we need to be on the shelf with the high THC bud that the consumer is demanding at the right price points. And so for us, we're going to continue to make sure that we're not stocking out at retail, which is not good for us, not good for brand building, it's not good for our retail partners. At the same time, we need to be able to bring down our total inventory balance. And that, as I said, is the work that's going on as we look at our footprint, because we need to be able to both decrease our inventory, make sure we stay on the shelf at retail, and deliver the quality experience that we feel should be expected of our brands. I think that's very comprehensive. I would just add, Michael, that I would not model that this is our peak quarter. I think as we do the strategic review, there's a lead time to any decisions that we make. That being said, I would not say that that the increase is going to be material in Q4. I just don't think that we can call it a peak at this point until we finish the strategic review of our footprint. But directionally, we know that we can do a better job of managing inventory relative to overall sales, and everyone knows the story of anticipated market growth and where we are. So we're working through that as we speak.
Okay, that's helpful. Thank you.
Your next question comes from the line of Aaron Gray of Alliance Global Partners.
Hi, thanks for the question. I just want to dive back a little bit into the market share trends. So I believe you said 22% for the rec market in the quarter. I think last quarter was just north of 25. So could you talk a little bit about the market share trends you saw during the quarter? Would it be fair to think that, as the quarter went on, you saw the market shares fall as you saw that aggressive pricing from competitors? And then as we see this aggressive pricing of competitors and potential shakeout, is it fair to think that we continue to see some at least near-term share being lost with the aim of long-term share gains, as you kind of made it clear that you're not going to kind of play in those super low-priced categories with the aim of coming out with more premium products and just having TWD. So how does think about near-term shares and kind of that long-term share aspiration? Thank you.
I'll take this one. So yes, we did see some modest share declines as you referenced, but I would also point out that there's been some variability in that as the industry has developed. What I commented on earlier around some of the isolated pricing actions, we've made a decision to not chase those price points in some instances. So there has been some share impact as a result of that. However, our goal continues to be achieving between a 25 and 30% market share. There's going to be a little bit of noise with some of these isolated pricing actions that we think will go away over the next several months. But 25 to 30% is really our goal. And we think we're well positioned to achieve that. But yeah, you might see some noise in the numbers, between now and call it the longer term.
And what I might do, Aaron, is also almost come back to Vivian's question and say, we like the split in the market with maybe 40% is more premium of the total market. I'm saying 30% is at value. We won't chase market share at any cost. But I think the best thing we can do to continue to drive market share for us is to make sure that for our premium products that we are on the shelf consistently at retail. I think that more than anything else can move the needle for us in terms of holding share or growing share in the near term.
The next question comes from the line of Rupesh Parikh of Oppenheimer.
Good morning. Thanks for taking my questions. So I wanted to go back to your other businesses and the acceleration that you saw there. So outside of, I know there was a seasonal benefit that you saw, but if you look at the stores and impactful vaporizer business and this works, just want to get a sense in terms of what's driving the strength of both businesses and just how to think about them going forward outside of that seasonal benefit.
Yeah, it's a few things. There's been a number of new items that we've previously press released. So innovation is driving a good portion of the growth. We have a new distribution agreement with Green Lane in the U.S., so we're seeing some good growth there as well. And we've built a good business. As you guys know, this is a fantastic brand. And as we talk about the brand building and being more consumer aware, I think Dave and I are of the opinion, as many of our management team is, S&B is an amazing brand that we could leverage for so much more than what we are today. So we're working on future plans to further exploit that brand globally. But a lot of innovation coming next year as well. So, we did have some seasonal benefits, but that being said, we still see that as a growth business over the next year or two.
Anything there?
Your next question comes from Graeme Kreindler of 8 Capital.
Yeah, hi, good morning. Thank you for taking my question. I wanted to follow up in the prepared remarks. You mentioned that there was higher capacity utilization in the quarter. When I look at the kilograms harvested figure, if my numbers are correct, it was around 29,000 kilograms this quarter, and in the previous quarter it was 40,000 kilograms. So that number coming down, just wanted to square that away with the higher capacity utilization, and also tying that back to talking about right-sizing the footprint, whether we're already seeing some evidence of that given where the harvested number is going quarter over quarter. Thank you.
Sure. Two things I would point out. Number one, given our large greenhouse footprint, yields vary throughout the year based on the season, and yields certainly are lower in the October, November, December timeframe, which we model in and take that into account in all of our standard costing. During December, we did take down some capacity at our Delta facility in British Columbia as one of our first steps to help bring supply and demand into balance. There are some fixed cost deleveraging input at Delta. We actually get benefits with the remaining facility and helping to improve yields there as well. So it's a very balanced approach. But when we think about broad utilization across our network, our overall network, despite the fact that yields ebb and flow throughout the year, the actual number of square feet in our facilities are operating more in line with their goal, with the retrofit activity being largely complete.
Your next question comes from the line of Owen Bennett of Jefferies.
Morning, guys. More of a modeling question from me. Obviously, because the other revenue line accelerating quite strongly, which you expect to continue. I was just wondering, could you give any insight into gross margins in the other revenue businesses, and even potentially kind of international medical business, to kind of help with how we see that sort of gross margin progressing throughout the year and what support it will get? Thank you.
So Owen, my recommendation would be that we talk to you offline about that versus going into a lot of the details. But the S&B, First and Free, C3 businesses have all been performing that 40% plus margin, and in some cases, C3 is materially above that, is our pharma grade cannabinoid based business. In terms of guidance on that from a modeling perspective, I think modeling S&B and First and Free in that 45% range is a good estimate, and C3's been in the 65 to 75% range, and we expect those to hold over the short term.
The next question comes from the line of Matt Bottomley of Canaccord.
Yeah, thanks. Just wondering if you could provide any color on the assumptions going into, I think it was about a $5 million price provision or sales allowance provision this quarter for related to particular SKUs or any other assumptions. And then also, if I could just sneak in there, if there's any color on the proportion of your inventory balance, at period end, how much of that relates to things like dry bud versus product in the pipeline to be launched in Cannabis 2.0? Thanks.
Sure. So yeah, we booked about $5 million in the quarter as a revenue provision, and I think just going forward, as we think about revenue provision, it's a cost of doing business, and every CPG company I've ever worked at has always had an ongoing provision, and it's really a function of what are your customer agreements. In this industry, our customer agreements in Canada are very favorable to the customer, meaning they can return anything at any point in time, which is a more, I'd say, liberal approach than what I've seen elsewhere. And hence, we take a slightly more cautious approach in booking revenue provision. As I think about modeling going forward, 3 to 4% of revenue is a very reasonable number given the risk profile, the amount of inventory that we see at the province level, And I would expect that to be kind of the normal range going forward. But we true it up every quarter. We look at what's actually come back, and it's meant to cover not just returns, but also any provisions for any potential markdowns, or we call them buy downs at the province level, just for the inventory that's within their four walls. This is not meant to be a provision for what exists in retail. It's meant to be just a provision for what exists at the wholesale level. So as wholesale inventories come down to that $4 to $6 million range, there's just not much risk out there. So the $5 million is, in terms of unpacking that for you, $1 million of that, $1.5 million, I think it was, for potential returns on just random products across the supply chain, where provinces are long on certain SKUs. It's very immaterial. And the balance was a provision for potential pricing impacts on certain SKUs in certain markets where we're not quite aligned to our national pricing architecture, and we wanted to provide that allowance so that we could get things lined up properly. But it's, in the grand scheme of things, it's 4% of revenue, and that's just going to be our normal course going forward. So I would build that in. Thank you. In terms of inventory, and I think your part two of the question was on inventory, so I apologize. But on inventory, yeah, so our inventory, we think about our inventory really in a few buckets. Number one is how much of our inventory is distillate and isolates and whatnot. And a lot of inventory that we're showing there is the anticipation of Cannabis 2.0. And, jury's still out on how big each of these categories are going to be, but we are well positioned on the distillate and isolate to fuel whichever category of Cannabis 2.0 SKUs really take off. And the shelf life on the isolate is very high. So we don't have any concerns around quality of that inventory relative to the shelf life. The balance of the inventory is really our bud inventory, and we feel very good that we're balanced on high THC bud. We feel very good that we're balanced on low THC, high CBD bud. The mainstream bud, which is the balance, is what we call it. We're a little longer than what we'd like to be today, and that's the piece that we're continuing to work through.
Your next question comes from the line of Jason Zandberg of PI Financial.
Hi, thanks for taking my question. Just first of all, wanted to applaud the reduction in operating expenses this quarter, especially G&A. One line item there that I think is positive that it's increasing is the R&D line. I wanted sort of to dig into that just for sort of future modeling purposes. You described the increase, and we're kind of in the mid-teens in terms of a percentage of revenue. Talk about some clinical trials with CBD-based studies, as well as some product testing for Cannabis 2.0. So is this a sort of one-time bulge in, not one-time, but sort of, over the next couple of quarters, a bulge in R&D, or should we expect this line item to increase? Sort of what's your long-term goal as a percentage of revenue?
So Jason, when R&D is an area that I've already spent some time on since I've been in the role, I think as we look at focusing the business, we have to decide where we're going to invest from an R&D and innovation standpoint. And by the way, there's a bunch of stuff in that line item. It's not pure R&D. Some of it's engineering activities. Some of it is even manufacturing engineering, right? So there's a lot of noise in that line. When we get on the call in the fourth quarter and we're providing more clarity on specificity of that focus that I want to bring to the business, we'll make sure that we address the R&D line in detail.
The next question comes from the line of Pablo Zuanic of Cantor Fitzgerald.
Thank you, and congratulations, David, on your appointment and on the good quarter. Look, just one question. It's a bit of an industry question. I think you said that value for you was 30% of the portfolio. I'm hearing from other people it's close to 50% of the industry. if that's what we are seeing in the flower market, does that say something about the Canadian consumer in cannabis being very thrifty? And does that bode badly for the 2.0 category as a whole, given that the price points are much higher? If you can comment on that. And then just if I can sneak in a quick follow-up, it'd be nice if you can clarify of the other line, what percentage of that revenue is outside North America? Thanks.
I'll let Mike handle the revenue, the other revenue. But yeah, Pablo, so I think the thing that's interesting to me is we have an existing consumer today that's been pulled largely from the illicit market. And if that consumer today is, if say 40% of the spend is happening in the premium segment in the market, so I'm kind of flipping your question around a little bit, we feel pretty good about that because I think that looks like a lot of other CPG categories. It's my belief that as we bring 2.0 consumers in, they're likely to come in at the higher end of the category because they're going to want, as well as premium bud, they're going to want experiences in other product categories like vapes and edibles, drinks, gel caps. We just see them coming in differently. Now, what I'll say though is that I believe that that's probably a longer build. So it'll take a while for that market to evolve. I keep talking about there are a lot of consumers that in the market today, and we need to delight those consumers. But there are also a lot more consumers that don't even know that they love cannabis. But they will learn that over time, and I think those folks will come in at higher price points and at the premium end category.
The other revenue?
Your next question comes from the line of Endri Leno of National Bank.
Hi, good morning, and thanks for taking my questions. Just wanted to go back quickly on the Cannabis 2.0 and particularly on the beverages first, but just if you are able to clarify what caused the initial delay and where are you now resolving the cause of that delay? And then more on the overall 2.0 portfolio, like how do you see it developing vis-a-vis the dry bud only that you have right now, and how much could it contribute towards, say, your previous guidance of $250 million revenue per quarter? Thanks.
So Chris, if you don't mind, I want to take Pablo's question because he got cut off there, but we will follow up. Tyler can follow up. Judy can follow up with you. But international revenue today, defined as revenue outside Canada, is around 35% of total revenue. And Judy or Tyler will follow up with you after the call to make sure you get your question answered. And with that, I'll turn it over to David to answer the beverage.
Yeah, so look, on beverages, whenever you launch a beverage, whether it's alcoholic drinks, the non-alcoholic drinks, and clearly cannabis drinks, it takes a while to get your formulations exactly as you want them. You need to ensure that you're having appropriate stability. We want the product to look appropriate when it's on the shelf. And we had time to do this work at lab scale, leading up to obtaining licenses from Health Canada on 2.0. But kind of post obtaining those licenses, we've only had a very short window of opportunity to go from lab scale production to commercial scale production. And we've had some issues as we've made that jump, and also understand that it's a very involved quality process that we're putting ourselves through because we believe these are spectacular products. We want to make sure that when the consumer tries them, that they decide that this is their thing, right? So we want to get it right. We're taking maybe more precautions than would otherwise happen in terms of working our way through that quality process. We have some outstanding scientific and engineering and innovation talent working on our 2.0 launches. And as I said, it's just taking longer than we would like, but we think it's worth getting the products right as opposed to just rushing them out there to make an in-market date.
Your next question comes from the line of Chris Blake of Laurentian Bank.
My questions have been answered. Thanks very much.
Your final question comes from the line of John Chu of Desjardins Capital Markets.
Hi, just quickly. So with the aggressive U.S. expansion on the product launches, we've got edible launches coming up now, and then it looks like you're going to be potentially adding quite a few more new retail stores, especially in Ontario. From a sales and marketing perspective, should we see that jump up for the next several quarters at least while you're trying to position the products and the launches accordingly?
No, again, we're still doing the work, John, in preparing for kind of the next phase, actually even working on next year's plan. So I don't have a definitive answer, but you won't see the number jump up.
Those are all the questions at this time. This concludes today's conference. You may disconnect at this time.
So that's the conference call. I don't understand what all the excitement is. Yeah, buy Canopy Growth. They only lost 92 million. I'm confused, man. So just getting tired of listening to these conference calls, and it's always the same thing. We're losing 92 million, but we're going to get better. We're losing 92 million, but we're going to get better. You lost 92 million. That's not good. You didn't win. You lost. You didn't make money. You lost money. And you want me to buy your stock? I don't care if you're up. I ain't going to buy your stock. I don't care if you got Drake. I don't care if you got Snoop Dogg. I don't care if you got Seth Rogen. I ain't going to buy your stock. The sector's been such a disappointment, man. Now, it doesn't mean that it can't get better. I pray that it will. A lot of our money's trapped in these companies, but Jim Cramer was right. He said, you know what, Rich? Well, he didn't say it to me, but he said, this sector's not what I thought it would be. And that is exactly how I feel. This sector is not how I thought it would be. I thought these companies would make money. They're all losing money. I was told by my friends on the black market. They're like, Rich, it's going to be a nightmare. You're going to get slaughtered. I didn't want to listen. I'm like, no, you guys are wrong. They're going to take out the black market. Look at alcohol. Not only did they not take out the black market is laughing at the public sector. My black market friends are laughing at the public sector. Five Finger Limited, I'm not being negative. I'm being realistic, bro. I'm being realistic. You may have been winning, Five Finger. 99% of the investors have lost. I have friends that have lost millions. I have friends that loaned money to Suniva. Suniva's not paying them back. They're defaulting on millions of dollars that they owe to private investors. So the reality is, some of you may make money and you're like, Rich, don't be negative. I'm being honest. I'm not going to lie to people. The black market in Canada is laughing at the public sector. These public guys continue to do these conference calls and talk about how great they're doing, but yet they lost $92 million. $92 million. They didn't make money. They lost $92 million. People in Canada are starting to grow their own. People in Canada are going to continue to go to the black market, and they're not going to buy off these LPs until the LPs lower their pricing. LPs don't want to lower their pricing because they can't make any money. This is a big problem. I don't see how it changes. This is what I'm trying to say. We need to change the way we invest. We need to diversify. And if you want to make money in the cannabis sector, I think we need to look at other types of companies like GRWG. Excuse me. Grow Generation Corp. They don't touch the plant. They sell ancillary products. So if an MSO needs soil, lighting, anything to grow, they go to GRWG. They're a profitable business. That's a business that has the chance to grow profitability. IIPR, they're in the real estate business. They don't touch the plant either. They pay a dividend. That's a profitable business. Valens Growworks, they're an extraction company. They take the extra weed that all these LPs can't sell, which is going to continue to be more and more and more, which I think extraction companies are the way to go. So Valens and Labs, in my opinion, the two best extraction companies and probably the two best buys in Canada right now because of the fact that they don't have to compete with the black market. You know, they're not dealing with the black market. So these extraction stocks, they're kind of the way to go because all these LPs can't sell weed because nobody wants to pay so much for this weed. So they have all this extra weed. They sell it off to the extraction companies. Extraction companies turn that to oil. They take the weed and turn it into oil. And the upside for them is huge. And that's why they make so much money. And that's why both Labs and Valens are the two most profitable companies. And I mean, they're not really profitable yet, but they're moving towards profitability. Two most EBITDA revenue growth profitability companies in Canada. And the reality is, until these LPs figure out that they need to lower their pricing, they're not going to beat the black market. The black market is laughing at the public sector. It's kind of funny. It's kind of funny when I see people. Oh my goodness. Appily Kakinen says, if you grow 4 plants in your home, you can get easily 500, 1 kg per plant with the right lighting. And more people are going to move to that because these LPs are just greedy and they're not lowering their pricing. And as long as they don't lower their pricing, they're not going to be able to compete with the black market. And as long as they can't compete with the black market, they're not going to be profitable. We have to diversify. These companies are not making money. Show me one that is. Show me a company that's selling flower that's making money. The only one is True Leaf. Whacker Beat says, from now, I'm strictly blue chips, as you should be, because right now the market is melting up. So that's the way to go. This entire cannabis sector has been nothing but a farce. Stolen all of our money. We've all been robbed. I hear from people all over the world. Some have lost millions. Some have lost hundreds of thousands. Some have lost tens of thousands. Some have lost hundreds. Pretty much everybody has lost. So there's some people here and there that are going to say, oh, I won. I mean, for every one that's won, 99 have lost. So at the end of the day, I talk to people every single day that are in the cannabis sector, and I talk to guys in the private sector. I talk to guys in the public sector. The private guys are laughing. They're making money. The public guys are losing money. And then they do these conference calls to talk about how great they are and how great they're going to do, despite the fact they've lost 92 million. Those are the facts. Call me what you want, say whatever you want, but those are the facts. I didn't hear $92 million in profits. I heard $92 million in losses. And I heard a bunch of institutionals talking about how great of a quarter they had. That's not a great quarter. When you lose $92 million, that's not a great quarter. That's not a great quarter. It's actually a terrible quarter when you lose $92 million. Explain to me how you lost $92 million. You create weed for a certain amount, and then you sell weed. Very simple. It's a very simple business. If I spend 100 grand to create my weed and I sell it for 200 grand, my profit is 100 grand. Now, if I'm losing $92 million, how am I going to compete with the black market? I'm not hating because of ACB. I'm telling you guys the truth. I speak the truth. I'm in the sector. I'm an investor. I interview CEOs. I talk to the black market. I go to dispensaries. I see the pricing list. The prices are ridiculous. The prices are ridiculous. These companies don't want to reduce their prices. If they don't reduce their prices, they're done. No one's going to buy it. So then what they have to do is they have to sell their bulk extra weed to all the extractors. Do you guys understand what's going on here? So they got all this extra weed that they can't sell because nobody's buying because it's so expensive. So then they're forced to sell it to Valens and Labs at a fraction of the cost. Valens and Labs are laughing because they're just sitting there buying all this weed for dirt cheap, turning it into oil, selling it off, and making a killing. That's why Valens and Labs are such great buys. The rest of the LPs are just a joke. They don't know how to make money. They don't want to reduce their pricing. So where's the end? How does this end? How does this end positively? Explain to me. I'd love to know how this ends positively when you're in a sector filled with guys that are not willing to reduce their pricing. You're creating the weed for $1, $2, $3. Okay, just so you guys know, I don't know if you guys are aware of this. Canopy Growth produces their weed for the highest cost per gram in the world for an LP. It's a fact. This is why Canopy Growth is losing money. Their cost per gram is way too high. Ridiculously high. This is why they're losing money, guys. Do you realize this? Yeah, hey, listen. Blame Health Canada all you want, but at the end of the day, does that help us as investors? Has Health Canada done anything to help us as investors? Canopy Growth has the highest cost per gram in the world. Where's the profit going to come from? When your cost per gram is like $3 or $4 per gram, then you got to pay employees, then you got to pay your salaries, then you got to do all this share-based compensation. So in the end, you lose 92 million, and then you get on a conference call and say, oh, last quarter we lost 150 million. We're on the right track. We lost 150 million last quarter. We only lost 92 million in this quarter. We're on the right track. Buy our stock. Yeah. You think I'm going to fall for that? Canopy Growth has the highest cost per gram in the world. Do your research. Do your research. Canopy Growth has the highest cost per gram in the world. Did you guys know that? All the experts that are watching that are telling me how great Canopy Growth is, they just lost 92 million. And the stock is up. If that's not manipulation, I don't know what is. Did you hear the guys on the call? Oh, congratulations on your great quarter. $92 million loss is great? In what world is a $92 million loss for the quarter great? Explain that to me. I'd love to know. Their cost per gram is too high. Canopy Growth's cost per gram is too high. They don't tell you guys that, but I do the research. I do the diligence. The cost per gram for Canopy Growth is too high. That's why they're losing money, folks. All these companies are spending more than they're making, and they're not willing to reduce their pricing because then they're going to lose even more. But the thing they don't realize is if they reduce their pricing, they're going to sell more, which means they're going to get closer to profitability. The reason why they're not selling and they have so much inventory is because the price is too high. So they're sitting on a ton of inventory wondering, I wonder why we can't sell our product. We got all this product in our vault, and I wonder why people aren't buying it. I thought the price of $300 per OZ was a good one. $300 per OZ is good, right? How about $240? $240 an ounce? Meanwhile, the black market's selling ounces for $100. It's so basic. It's so basic. It's so basic. Like the private guys, they laugh. They go rich. I talk to my private friends that They're making a killing. And they say, Rich, I'm opening up 3 new locations. These LPs are shutting them down. Oh my goodness. They're like, it's such a simple business, Rich. You spend 100 grand growing, you sell 200 grand worth, 300 grand worth, 400 grand worth, you make 100, 200, 300 Gs. How are they losing money? How are they losing money? I'm like, They're like, Rich, you want to buy an ounce? I'll ship it to your door for 120 bucks. Try to show me an LP that's selling an ounce for 120 bucks. There is none. There is none. There is none. So the reality is all these CEOs of all these public companies have no clue. And I'm disgusted and disappointed because I invested my money. I invested my time. Our community invested our money and your time in a bunch of lies. Now, I'm not trying to say that some won't win. Some will. Those are the ones that have the lowest cost per gram and the best pricing. It's very simple. It's a very simple game, man. It's a very simple game. It's been happening for years privately. All these private guys are making so much money. And then the public guys have no clue how to make money. Why? Why? Listen, man, if people want to win, they need guys that understand the sector. If these public companies want to win, they need a guy to come in that can teach them how to compete with the black market. The black market in Canada is $5 billion. There's a huge amount of opportunity there that nobody's taking advantage of. Why? Because they don't know how. They're not black market guys. They're bankers. So you got a bunch of bankers getting into a sector trying to compete with black market guys, and they've never grown any weed. And they're not willing to reduce their cost per gram, and they're not willing to reduce their pricing. And if you're not willing to reduce your cost per gram, and you're not willing to reduce your pricing, you're not going to be profitable. And if you're not going to be profitable, eventually you're going to run out of money. You got to be street smart if you're going to compete with the street. Do you understand how much $5 billion is? $5 billion is there for the taking. It's very simple. Undercut the price. I've been saying this for months, but nobody's doing it. Hexo comes out with a product saying they're taking out the black market, but their pricing still is not better than the black market. CANNABIS says, we've got the re-up product. We're going to take out the black market. They're still not cheaper than the black market. They're not. The black market will continue to reduce their pricing to continue to exist. That's the reality. The public market has to reduce their pricing to compete with the black market. It's a very simple solution, but they're not willing to do it. Why are they not willing to reduce their pricing? This is the part that really frustrates me. I think Hexo might be on the right track because they have a low-cost product, and I said this since day one. That's the only way to compete with the black market is to reduce your pricing. They have a low-cost product. They have a low-cost product. $140 an ounce is relatively good. It can compete with a lot of black market guys. Black market guys are still selling ounces for $200 here in Vancouver. Some are selling for $220. Some are selling for $100. But usually if you buy an ounce for $100, you got to buy in bulk. And if you buy an ounce for $100, sometimes it's good, sometimes it's not. You get what you pay for. So if the LPs want to compete, they've got to try to come up with a $100 ounce, $120 ounce. It's very simple. They don't want to. This is why they're not going to exist. They're going to fail. Troy Welsh says Xena is 150 an ounce for some of the best weed in the industry. I buy Xena product. I know what you're talking about. You're talking about the re-up. It's pretty good. I wouldn't say it's great. I think it's okay. But yeah, their pricing and their cost per gram is lower. That's why I believe in Zenabis, or I have believed in Zenabis. But despite the fact that I have believed in Zenabis is running out of money. So that's the other issue, is a lot of these LPs, because they have so much red tape, they've got a piece in the government. They got to pay taxes. The private guys don't have to do any of that. So because the private guys don't have to do any of that, it's not a fair situation. So this is why the LPs are in trouble. And the private guys are laughing. The private guys are laughing because they don't pay taxes. They don't pay the government. So right there, they're saving a huge amount of money. So what's happening is the LPs are in a tough situation. Jimbo says, respect your money. Don't invest in bad companies. 100%. We're in the middle of a market melt-up like no one's ever seen in history of the stock market. Take advantage of the market melt-up, guys. It's happening right before our eyes. The government has been making it very difficult for these LPs. They're not opening up more stores. LPs are sitting on a lot of inventory. They're not able to sell it. And one of the reasons why they're not able to sell it is because of their pricing. The pricing is very, very uncompetitive with the black market. And that's why the black market will continue to flourish. I've been talking to my black market guys and I'm like, man, you guys got to, be careful because some of these companies are coming after you and they're going to reduce their pricing. And they say to me, yeah, I've heard, the Hexo, the Zenabis, but their weed is trash. So everybody has their own opinion about what's going on. But remember, I actually talk to the black market guys. They're my buddies. I've grown up with them. They tell me the real. Some of my black market guys have been getting offers for jobs, $250,000 a year to grow for the LPs. And they laugh at the LPs and they're like, no, I don't want to work with an LP. So the black market has $5 billion of money just sitting there for these LPs to go and get. And the LPs just don't get it. Reduce your pricing, guys. It's very simple. Lower your cost per gram, reduce your pricing, and sell more weed. It's very simple. Reduce your cost per gram, grow better strains that people want, and reduce your pricing. And that $5 billion that continues to go through the back door, through the black market, will be yours. So instead of making $1 billion like what the LPs made, collectively, all these huge LPs made $1 billion, the black market made $5 billion in Canada in 2019. $5 billion is on the table for all these LPs to go and get, but none of them know how. Well, I already told you guys how. It's pretty basic. It's pretty simple. Growing weed and selling weed is like, I've never grown it, but my buddies that do it, I mean, it's not hard. And they're making money. But you got all these huge companies with all these huge overheads and all these employees and all these consultants and all these lawyers and all accountants and all these experts, scientists and growers and all these people they got to pay. And they're not making any money. So guess how they pay them, guys? How do you think they pay them? They sell stock. It's pretty obvious. And they're selling stock into us, the retail, and we're buying their paper. And that's the game that the LPs are playing. They're not playing a game of profitability because they're not profitable. They can't compete with the black market. So the only thing they can do that the black market can't is sell paper, because the black market doesn't have paper because they're not public. Just trying to educate you guys, let you guys understand what's really going on here, because this is a really, really dangerous game that we're playing. So at the end of the day, it's very simple. If you want to compete with the black market, lower your pricing. Now, I have the solution. These public companies should be paying me for this. But anyways, I'm just going to share it because whatever, who cares? Okay. Every single black market dispensary has a premium product, which they sell for like $20 a gram. And they've got their house product, which they sell for $4 a gram. I live in Vancouver. There's a lot of private dispensaries still open, believe it or not. Walk into them. Hey, sir, how you doing? We got our premium products here, $20 a gram, as much as $25 a gram for the premium product. And then I got the house product for $4 a gram. $4 a gram, 28 grams, $112 an ounce. Not one LP can compete with those prices. Not one. Nobody has products at those prices. Nobody. So you walk into a dispensary and guess what product? What do you think? Every time I walk into these private black market dispensaries, the first product to go is the $4 house product. The weed sucks. Shit weed. But why do you think it goes first? The product goes first, even though it sucks. And it's just garbage weed. Why do you think it goes first? Because premium brands? And they should have house brands. And the house brand should be $4 a gram. And it should be able to compete with the black market. So you should be able to go and get $100 ounce from Aurora Cannabis, $100 ounce from Canopy Growth, $100 ounce from Aurora Cannabis, Canopy Growth, Afria, Zenabis, all of them. Chronos Group, you should be able to get $100 ounce. And then you should also be able to get your premium bud for the high-end, high net worth investors, high net worth people that want the best. They'll spend $300 an ounce because they can afford it. But then there's a lot of people, I would say about the 95%, that are going to go for the cheapest product because that's all they can afford. And they'll buy the $100 ounce. Now, what I do is once in a while, I'll buy some of the cheap shit, the $100 ounce, and then I'll buy the premium stuff and I'll mix it up and change it up. So once in a while, you try out the premium stuff. Once in a while, you try out the garbage stuff. Put it together, make a salad. This is basic stuff, guys. If you're a public company and you don't know this, it's like, where you been? Have you even gone to a dispensary? Do you even know the sector at all? Do you even understand what is going on? Do you even have a clue? Because this has been happening since the beginning of time. Like, go to your black market dealer and he's got premium stuff. He's got like 10 different kinds, right? What do you want? You want the ounce for $240? You want the ounce for $120? It's pretty basic. But these LPs don't have a clue. They really don't have a clue. So this is the part that's concerning to me, is that they have yet to really understand the market. And until you understand the market and you have a guy like me consulting you that understands the market, I told you guys, I know more about this market than anybody. I'll go head to head with anybody. When you talk about the private sector, the public sector, the stock market, overall, running a public company, doing filings with the SEC, converting debt into equity, creating convertible preferred shares, I understand it all. We're going to take Rich TV Live public. But I wanted to make sure that when we took our company public, we had a huge community, which is growing 80,000 people worldwide, and that we're profitable. Because why would I take my company public if I'm not profitable? That doesn't make sense. But all these companies were in a rush to go public so they could sell stock. Let's be real. None of them are profitable. None of them are profitable. No, I'm not trying to get hired, Mr. Liu. I already run my own business. I couldn't give a fuck about the job with Aurora Cannabis. That was a fucking joke. You think I care about being the CEO of Aurora Cannabis, a sinking ship? You're joking, right? I got private company guys that are my buddies that I can go and run a public company with that will actually make money. Why would I go and hitch myself to Aurora Cannabis? I couldn't give a fuck about Aurora Cannabis. I couldn't give a fuck about any of these companies. I have my own business that I'm building. And I don't need to be associated to a bunch of companies that are stealing people's money because that's all they're doing. Do you honestly think I want the job with Aurora Cannabis? That was a fucking joke. I don't want that job. I got my own business. I got my own career. I ain't at work. I'm chilling. I'm going to go play football with my son. I have freedom. I'm an entrepreneur. I don't got no boss. I don't need to go work with any of these LPs that are starving. I can build my own business anytime I want. I got friends that are private guys that are saying to me, Rich, let's go public. No, I was joking. I didn't think that everybody was going to be like, yes, Rich, you be the Aurora Cannabis CEO. Do you guys honestly think that I want to be the Aurora Cannabis CEO? Come on, guys. Let's be real, guys. Like, let's be real. I ain't trying to get no job. Job stands for just over broke. I don't want nobody's job. I'm an entrepreneur. I build businesses. I have my own business, which is growing. I don't need anyone else's business. You know, it's funny. So many people messaged Aurora saying that I should be the CEO. I'll bet you that pissed them off so much. I enjoy my freedom, guys. Yesterday, my son's trying out for the Vancouver Whitecaps, professional club. I like that. I don't want to sit there and stress about the millions I'm losing in my business and all the shareholders that are calling wanting my head. That's what Aurora is dealing with. Understand? That's a very stressful job. So anybody who takes that next CEO position is pretty much a lame duck CEO. Not every CEO makes $50 million a year. That's for sure. The CEO of Aurora was making $500,000 a year. Mind you, he probably made $100 million selling stock. Of course they know me. Everybody knows me. But the reality is these companies don't want to bring me in because they know that I will pick them apart. And if I go to the table and I start seeing the financials and I start seeing everything that's going wrong, I'm just going to walk right back out the door. Just walk right back out the door. I'm like, this is not going to work. You got to pay for this, and this. You're making this, and this. It doesn't add up. You're not going to be profitable. You're not going to make money. Mr. Lou says, Rich, if ACB calls you right now and offers you $400K to take the job, you wouldn't. ACB is not going to call me. And because they're too arrogant. I know. I'm in the sector. I speak to these companies. They're not going to call me because they're too arrogant. But if you guys pay attention, you will see. I think you will see that I speak to quite a few CEOs every single week, often on air. So I know exactly what's going on with the private and the public sector. No, I wouldn't take the job for $400K. Because the reality is, I can make way more than that in my own business. So why would I take a job for $400K when I can make more money in my own business? I don't have all the overhead that Aurora does. I don't have to pay hundreds of employees, thousands of employees. I don't have to pay the government a piece of my business other than paying taxes. These LPs are doomed. They do not know how to make money. They do not understand the business. They do not understand the black market. They do not understand how to compete with the black market. I guarantee you ACB will not call me, and I guarantee you ACB will not even be interested in hiring me because ACB wants their own guys. ACB wants their own internal guys. They want their puppets. Don't you guys understand what's up here? They need their puppets to sit there and tell people why their company's so great, despite the fact they're losing money. I'm not going to sit here and tell people to buy my stock, despite the fact my company's losing money. Do I have any exciting vids coming to members? I'm always working on bringing you guys videos and picks and new companies, always. Mr. Lou says, I would take the job for $300K, and yes, the company can be turned around. So then take the job. Get the job. Go get the job. Jimbo says, my opinion is that it's dangerous to let your money in cannabis stocks. 100% it's dangerous. Look at what's happened. We've all been slaughtered. You can't compare Tesla to any of these cannabis companies. Tesla made $20 billion in sales. None of these cannabis companies, including Scott's Miracle-Gro, is even close to $20 billion in sales. So when people try to compare these cannabis companies to Tesla, I laugh. These cannabis companies are not Tesla. RE Royalties, bro. Troy, RE Royalties is a beast. They pay dividends, and I'm working on getting them on my show. Alberto Ramos says, ACB not pushing over 100 million, be the RIP moment. ACB's struggling and they're in trouble. You think I want to go and be the CEO of that company, which could potentially go bankrupt? They're in trouble because they don't understand that they have to lower their pricing to compete with the black market. If they lower their pricing, they're going to do more sales. Work on lowering your cost per gram, lower your pricing, do more sales. Eat into the $5 billion that the black market is taking off the table every single year. And that extra $5 billion is in your bank account. RE Royalties, Troy. I interviewed them, beast mode. I interviewed them at the VRIC conference. They were at 90 cents. Now they're at $1.30. My lawyer friend works for them, and she told me about them first months ago when they were at 50 cents, and now they're at $1.30. So you guys have to understand, like, I talk to people in this industry every single day. I talk to investors. I talk to lawyers. I talk to accountants. I talk to attorneys every single day. I like Grown Rogue. Grown Rogue is a company that's a small business, but they're going to grow. And they understand that they need to be competitive in pricing. And that's why I believe that long-term, they're going to be a winner. But it's going to take some time. And when you hear me speak with the CEO, he's very focused on profitability, keeping his expenses down. He's not trying to build a $100 million a year business. Right now, they only have a $4 million a year business. They're expecting this year to do $8 million. But they're focused on growing slowly but surely. They're not focused on trying to be a world beater and losing so much money. That's the way to go. You're not going to succeed in this business by spending all your money, which is what we've seen Zenabis do. We've seen Suniva do. We've seen Hexo do. We've seen Aurora do. We've seen so many companies spend to be first movers. And now they're all just losers. Infinite Possibility says, where's the best place to plant? In my home or my shed? A lot of people do it in closed environments like your home, a basement, garage, shed. People use trailers here in Vancouver, and a lot of people grow outside. But you got to do that in the summertime so that there's a lot of lighting. Troy Welsh says, do me a favor, look at NTAR. RE Royalties is the only video I haven't watched yet, literally the only one. Buddy, they are a beast, and they pay a 4% dividend. I couldn't care less about the Aurora job. I'm not doing this for the Aurora job. I don't sit here and talk about Aurora Cannabis every day like some other YouTubers do. I talk about everything. I talk about the whole markets. I do travel videos. I do sports videos. I talk about the coronavirus. I educate the public. I talk about different companies every day. I don't just sit here and talk about Aurora like other people do so they get views. It's not what this is about, man. This is about building a media company that's going to educate and entertain the public. That's it. You think I'm going to stop doing this? I don't want to stop doing this. I love what I do. I don't want to run a licensed producer. It's not what I want to do. It's not what I want to do. It just doesn't motivate me. It's not my passion. I was saying that jokingly because I believe I could do a better job because I think that a lot of these companies suck. And I've been really disappointed. And I just disgusted by the amount of ridiculing and mocking I've been hearing from the private sector about the LPs. And all my buddies saying, Rich, man, when are you going to give it up on these LPs? They all suck. They're all losing money. When are they going to make money, Rich? And the answer, I don't know. The answer is I don't know. I honestly don't know. I don't know. So yeah, I ain't going to stop doing what I'm doing. I love what I do. I believe that I've got a really profitable business opportunity here with Rich TV Live. Bloomberg makes $10 billion a year, guys. Bloomberg, they're a media company. I'm okay with that. If Rich TV Live eventually becomes the next Bloomberg and we talk sports, stocks, news, and travel and trending topics, and we can make $10 billion one day, I'll be okay with that. I don't need to run a cannabis LP and compete in a failing industry. I don't need to. I'm okay being in the media industry and competing with companies like Reuters and Bloomberg and CNN. I'm okay with that. Hey, say what you want about Bloomberg, but they're extremely profitable. That is a profitable business. That is a media giant that's a profitable business. Same with Reuters. Reuters makes billions every year. Jimbo says, I will buy Rich TV Live stocks for sure. Well, you know what I'm going to do for you guys is when we go public, and I plan to go public in less than 2 years. When we go public, I'm going to give you guys, the shareholders, an opportunity to buy into our stock early. I'm going to give you guys the chance to get in at around 10 cents. And my goal is to go public at $1. I want to have 50 million shares, issued and outstanding, very tight float. And I want to keep it tight. And I want to raise, a few million bucks at $1. But I want to raise a little bit of money in the beginning with my shareholders, with our friends and family at 10 cents. The friends and family that get into 10 cents will be preferred shareholders. Yes, it'll be preferred stock. And I'm going to get you guys in at 10 cents. And you know why I'm going to do it at preferred stock? You want to know the secret of preferred shares? I'll guarantee you that 99.9% of these CEOs don't know this because they don't have preferred shares. So I'll give you guys some free information since I like to do this. Convertible preferred shares are anti-dilutive. So if you guys invest in Rich TV Live at 10 cents and the stock goes down, do you know what I can do for you? Let's say you invest $1,000 and for whatever reason we get shorted and you left shorts Rich TV Live to 5 cents. You know what I'm going to do for you guys? I'm going to say, listen, guys, since you guys are preferred shareholders, I'm going to let you convert at the par value of the public company at, let's say, 1 cent. I'll make the par value a penny. So I'll let you convert at the par value of 1 cent. And what I'm going to do is if you don't pull out more than what you invested, I'm going to give you more shares. Very simple. I just want you to make money. I want my shareholders to win. So all the key guys, all the first investors, everybody that gets in, usually about 250 to 500 investors, they're all going to get in at 10 cents. I'm going to give you preferred shares. And then if for whatever reason you're unable to make money converting your preferred shares, because you can convert a portion of your preferred shares into common stock. And if you come back to me and say, Rich, I invested $1,000, but I only pulled out 500, I'm going to say, you know what, John? Here's some more stock. It's so simple. Now, do you guys think any other CEOs are doing that for their shareholders? Just want to know if you guys think there's any other CEOs doing that for their shareholders. Because I'm going to do that for you guys. Because for me, I care about my shareholders. My shareholders will be my business. I will work for my shareholders to ensure that they make money. I'm not going to be crushing my shareholders, slaughtering my shareholders to try to make money by selling stock. My goal is to make money as a business. So when we go public, I don't need to make money by selling stock. I want to have 50 million shares. I want to hold it tight. And if I bring in a large institutional investor, I want to bring them in at least $1. So everybody that gets in at 10 cents has a chance to make 10 times their money. So if you put in $1,000 and we go public at $1, you're making 10 times your money. Oh, believe me, I already got banks and investors that will work with me. I already work with banks and investors. So trust me when I'm telling you that they will work with me because they're already working with me and I know them all personally. You think I don't know the banks? You think I don't know the investors? You think I don't know transfer agents? I know them all and they know me. I've been working in this industry since 2007. So trust me when I tell you, we will have no problem raising money. What will be my revenue streams? Same revenue streams I have right now. Companies pay for media services. They pay for visibility. And as we get bigger, they're going to pay more. And as we get bigger, they're going to pay more. And as we get bigger, they're going to pay more. So if they want to get onto Rich TV Live, they're going to have to pay for it, folks. That's just the way it goes. How do you think Bloomberg makes money? How do you think Reuters makes money? Advertising. It's very simple. How do you think Facebook makes money? Advertising. It's very simple. So as you get bigger and you become a global media giant, companies will pay for advertising. They pay to advertise on your website. They pay to advertise on your streams. They pay to advertise because you've got a huge audience of people and they want those